And actually, what I was going to try and focus on is slightly different from what we heard this morning, and I'm sorry I wasn't able to be with you yesterday. But following on from what we've just heard with Lester there around risk, and where do we see risk in the economy in general, but specifically around food systems and how food systems link into risk for investment and finance. So a quick overview of how I look at risk and sort of interconnected risk, and then what we're trying to do to help understand this risk and what it means for an investment for large capital providers, pension funds, and how we're trying to do some of the modelling to get better understanding of some of the risks that we've just been talking about. So in terms of how what we're thinking about and all these interconnected nature of the various different systems that interact with food and agriculture in some way. It's obviously energy, food, water, land, metals, social mobility and health, capital availability and the environmental loading. So all of those will come into some sort of policy jurisdiction at some point, some sort of regulatory framework. They all come into the food system at some point, into the food supply chain. So how do those all interplay to provide different sorts of risk that we need to try and understand better to make sure that some of the IRRs that we're looking at for agriculture investment we can actually achieve over a long time frame? Those are the three sort of key boxes that we look at, the sort of links between food, water and energy, and we've heard how important water is in this space globally, but also in particular countries it's more important. But increasingly the link between energy and food, and the link between and the demands are on water between energy and food. So do you want to use all of your water in the US on gas fracking, or do you want to use it on providing people water in their homes, or do you want to provide water for food and for biofuels? So there are some sort of big decisions that we need to make that are very interconnected, and trying to understand and model those risks and how they translate into financial risks. So just in terms of the global pressures, where do we start? Why is this an important issue globally? So obviously at the map of the world, that's the growing population. That's how I sort of view the world in terms of population growth. So this is just map of the world distorted according to where people live. So what has agriculture and food linked pretty much with the health system done for us over the last certainly few decades, if not last century? Basically, it's made us all healthier. We're living longer. We are getting better well-being. Apart from in sub-Saharan Africa, but the general trend is that we are a healthier population, which is a great good news story. This is why we need more investment into agriculture and food systems and in our health systems. We've also been getting less poor on average, certainly up until around 2008. Again, sub-Saharan Africa is staying fairly stable at above 50%, below absolute poverty, but everywhere else has been getting better. So we've been getting healthier and wealthier, and that increases our pressures on the world, but it's also partly down to the investments we've already made into agricultural systems, and mainly health systems, and increasingly energy systems. There's always a but, and this is where the risks come in. The key one is obviously water. So we saw some water stress regions this morning, current ones. These are future projections, so these are by the middle of the century. So when you're thinking about agriculture investments, while they're sometimes short-term, quite often they're long-term. So this is where is going to get worse for water availability. This is just in terms of current economic activity, projected future economic activity, and the additional stress. So you don't really want to be in the regions that are in red. That's where there's already existing water stress. What you're going to be doing in those regions is playing water and energy off each other. So using more energy to do desalination, to do irrigation, to get water from different sources, to pump from groundwater sources. So you might be able to push it out a few more years, but certainly not that long. You don't want to be buying and investing significant amount of money in agricultural areas that are in those red zones unless you can also tackle your energy and water problems at the same time. So that's huge swathes of very productive land in the US at the moment, the east of England, and then predominantly Africa around the Middle East and China. Soils, again, over-degradation and overuse of soils and unsustainable use of soil. So this is a map of the world around soil degradation. So where are the risks around soils? And you can sort of see here, Latin America and Africa, but also Europe, China, again, we're overusing our soils, so how we manage soils so that they continue to be productive over the long time frames that we're thinking about for sort of economic risk is really important. And then on top of that, the resource constraints, the sort of peak oil, but really pricing is the most important thing here. So this is just a map of key resources and how many years left based on current best guess estimates. So these are the estimates from, for oil, the large oil companies, the big mining companies for the metals, the big nuclear companies for uranium. So this gives you sort of current day consumption and current day reserve estimates, so how many years left. So we may find some more reserves, but we are on an upward trajectory in terms of usage. So this is probably best guess, best estimates for when we actually run out of stuff. So 50 years left for oil. If you're in the Indian business, you've got about 12 years left to get out of that business. But importantly, it's what is in your supply chain that you need for risk and investment. And this is basically a price question. So all of these resources and things that rely on these resources are going to get more expensive. So what does that do for your future returns? Pretty much everything relies in some way on some of these key resources. On the other end of things, then, it's the environmental loading. This is the planetary boundaries work from Stockholm. So this is just looking at where we're loading the system. So what this is going to be telling us is where regulation is probably going to be focused coming forward. So the sort of green circle in the middle is the naturally sustainable, where the Earth can replenish itself. The red bars are where we currently are, and you can see that we're over on the nitrogen cycle, on climate change, very close on the phosphorus cycle, and on ocean acidification, and we're way over on biodiversity. The big question on biodiversity is, does that really matter when you're thinking about investments? Does that translate into any sort of financial risk? It translates into lots of other sorts of risks, but how you translate that into monetary value? Climate change is easier to translate into monetary risk. Nitrogen phosphorus cycle through soil degradation is much easier to translate into investment risk. So already economic losses are occurring, so we're starting to be able to model the sort of values at risk from finance and investments. And this is from Swiss Re, they're Munich Re, so lots of big reinsurance companies spending a lot of money trying to understand the changing patterns of economic loss from natural hazards. So this is catastrophe risk, which includes things like earthquakes, but predominantly the orange ones around there are extreme weather, floods, and storms, including hail. So you can see the big economic risk and where you're seeing increased economic risk to the assets in which you're investing. What happens to the insurance sector will be really interesting to watch. The other thing that we're looking at, which is sort of slightly less relevant for the investment risk, but in terms of an economic risk and then potential government responses, this is increasingly important, and that's constraints on capital. So this is just the countries within the world, their foreign reserves minus their debt. So if everyone stopped trading tomorrow and everyone had to rely on their own cash reserves, then which countries would you want to be in? Obviously China is in massive surplus and the US is in massive debt. So if you actually had to buy all the resources that are getting increasingly expensive, then something is going to be happening around political stability based on this. It'll be interesting to see the next century what this translates to in terms of access to resources and access to increasing expensive resources. So basically, in summary, and then thinking the next part of the presentation is thinking a little bit more about investment risk, but resources getting more expensive, environmental damage is getting more expensive, and increasing regulations are being put in place, even though there have been a sort of pause in regulation probably over the last few years, but that's going to come back on the agenda quite strongly towards the middle of the next decade probably. So environmental damage getting more expensive. Capital is becoming more constrained, certainly government capital is becoming more constrained, and we've seen population growth has been a problem, but global population will peak, and there's a really interesting issue when you're thinking about long-term investments about what a peak in population actually means. So when populations start to fall, what does that actually do for global economic growth and returns and the different dynamics around countries? So thinking about population and how all that fits together. So what are people talking about in terms of solutions to this? How does this fit into long-term planning, political agendas? So the sort of three general areas that people have been talking about in the political agendas: growth is the solution, so we can fix this just by growing more, by investing more into what we currently do. Technology will fix it naturally. Green growth is a slightly more guided growth, so we can put in place green policies that would encourage the right sort of technologies or environmentally friendly technologies to come onto market, and we can have a more green growth. Increasingly narratives around the end of growth, so we're going to be peaking growth. What does that do for investment returns? How can you manage large-scale pension funds if there is no growth? And then there are still and increasingly amounts of beyond the limit, so the sort of collapse of society type research that goes on in there, and what that does for particular countries. And beyond the limits isn't necessarily a global thing, but certainly there are some countries which are more susceptible to going beyond their own limits. So the sorts of investment impacts that we're trying to analyse and model is the sort of overarching reduced economic growth. What does this do for global economic growth? Where are the risks in economic growth? Reduced access to commodities and the increasing price and volatility of those commodities, which is really important when you're trying to do this sort of financial planning. Lack of availability is quite difficult to do anything about, but trying to build in resilience into those investments to cope with lack of availability. But increased pricing, it's easier to model and therefore easier to include in investment decisions. Reduced international security and coordination. This is basically around where you're investing, which countries are more stable or more resilient to these sorts of shocks. So we're seeing what's happening around the world at the moment in some of the countries that used to be stable becoming more unstable, some countries becoming more stable. So resource shocks will increase those sorts of trends. Repression of investment returns by governments. This is where capital constraint on governments may cause them to do something you don't want them to do, as well as public opinion causing them to do things you don't want them to do, by moving the returns that you can get from food or regulating around agricultural investments, but also energy and other things, to repress the investment returns so that they can shift capital around to build more resilience in their own countries. And changes to life expectancy and morbidity, which basically changes the expectation of return on the investment. So what do people expect if they're living longer or living shorter? What sort of return rates do they expect from their investments? So specifically on food risks, so this is trying to understand how all of these things interplay. How do you then translate that into food risk? And this is a sort of demand side of food risk. So which countries are more at risk of food shortages, and then thinking about their responses to food shortages. Unfortunately, from a sustainable development point of view, some countries are more important when it comes to food shortages globally than others. You can have famines in several countries and it doesn't really shift global economic growth. If you start to have food shortages and food price increases in other countries, it will have a significant impact. For example, in the US, if there is 2 or 3 years of drought, which we almost had, which wipes out corn production, that will have a significant economic impact on food, and therefore increasing stress on the US political system, which there already is. Price risks, and this is the sort of, Jeremy Grantham has done lots of work on this sort of view of we're in a new price paradigm in the last decade. So we used to have long-term falling prices in commodities. They're now going up and they will continue to rise. We're certainly now in a new regime for oil, and food has closely matched that. And then what does that do? At what sort of levels do you get this sort of social unrest? So there is lots of research now going on about whether you can actually predict, not exactly which countries, but the likelihood of some countries having another Arab Spring. So this is food price links, and they're very well correlated with the Arab Spring. Changing asset value, and this is thinking a little bit about climate change and the long-term projections, in particular around water availability. So this is the US over the last 20 years. So this is the sort of productivity and what you would ideally grow in these regions. So this is about diversification of crops. It's also about changing crops with time and having the flexibility in the investment chain to be able to change what you're growing according to food quality, food type, and then changing weather patterns. So it's not a long-term thing. We're not thinking about what does this look like by the end of the century. It's already happening now. Trees are going further north. area is becoming productive that wasn't productive, and area is becoming less productive that was productive. So how you have the resilience in investment strategies to be able to cope with that, and political strategy, is really important. So what we're trying to understand when we're doing these sorts of modelling, putting everything together, is what the government response is likely to be and what investment response is likely to be. We think government response to food security in particular will determine future asset values, and the productivity of the food system and the management is key to understanding how to get a better government response. So how investments are managed and how food systems are better managed should, if engaged in the right way with governments, lead to better responses, better managed responses over the long term. So we don't get short-term shocks and we don't get reactive reactions from government. So what we're trying to do is integrate food systems with energy systems, with water systems, with finance and policy needs. So trying to put all of that together in a model, which as an academic is really interesting, but it's sort of trying to predict the end of the world at one end of the scale and future global economic growth on the other. But this is just an example of one of the projects that's now going on. This is the Knowledge System for Sustainability, which is a large global collaboration, basically an open data collaboration. So can we get access to agricultural data, to food systems data, to energy data, to water data, as well as to political decision-making process data. So can we get governments to open up their information, pricing and everything like that, put all that in the open space so that commodity traders can understand it, can look at it, can try and do future pricing modelling. Academics can look at it and try and do the underlying economic risk and investment risk. But can we try and find these sort of structural issues that we need to address and work together to try and solve? So it's making data available, it's making modelling resources available, and it's making decision sciences methods available so we can get better decision making out of it. This is the sort of layers that are being put together. Here are all the partners that are working together on this sort of KSS platform led by the University of Wisconsin. And they've been doing a lot of work, in particular in the US, with lots of data in the US, down to the individual cow level, all the way up to global food systems and resources. So there's a huge amount of information that you could do a very detailed model of the world. The key thing that this lot are trying to engage, and you'll see the preponderance of universities and government agencies in there, is now have a much more detailed conversation with insurance sectors and with investors about which bit of this is relevant. How do you actually make decisions? How do you actually think about long-term risk and financial return so that this is a relevant bit of information for you going forward? So working together with all these to try and make that data available, bring it together. What we're trying to do at Anglia Ruskin is sort of take that and look at the reason why you would want to engage with this at the sort of global level, so a global resource observatory, building models that then link into financial and investment models. So we're building systems dynamic model and agent-based model for country level risks. So looking at what this does at the country level so you can map that across onto some of the investment. And trying to build at the back end of it a sort of finance model coming out of the actuarial sciences and the insurance sector, looking at scenarios for future impacts. So what will this do for discount rates? What will this do for likely return rates going forward? They're all likely to return to change in this sort of resource-constrained, water-constrained, increasing food price volatility change, but exactly what does it mean? How do you include that in your modelling? So what can you do with discount rates? What will it do to inflation, which then has a big impact on expected return rates? So especially the government response to price shocks could have a significant impact on inflation if they start to pump more money into the system to cope with short-term price shocks, for example. So this is a sort of mathematical model. It's also scenario-based work. Trying to build it into investment decisions. So this is just one of the scenarios that we built for the Institute of Actuaries in the UK, trying to look at economic risk and pension return risk in particular. So looking at how sensitive markets are to things like agricultural systems and how sensitive governments are to things like agricultural systems. By sensitivity we mean how long term do they think? Do they think in 1 year time horizons or 5 to 10 year time horizons? So these are the sorts of things we're building in actuarial models. There's a 250-page report which you can download from the Institute of Actuaries if you really want to read it. There's also a 20-page summary. But this is useful to do at the sort of political level, at the country level. What's more useful for investment bodies to do is actually at the asset level and the individual fund level. So what we've tried to do is take these sorts of figures and build them into investment funds and try and do forward projections about what this potentially means for investment funds. And modelling this at the moment around pension funds, so this is a defined contribution replacement rate. There's lots of different models and outputs that we've got, and getting more sophisticated about this. So this is just looking at economic risk and what it potentially means for pension funds. And you can see under no constraints, so there's no problem in the system. The black line, you get what you have now all the way through. Pretty much every single all the other scenarios we were able to come up with, you get a worse replacement rate for defined contribution, apart from wage stagnation, basically getting a higher replacement rate because your wages are lower. This is defined benefit asset, so this is just an asset return for different asset class just an overall asset. So again, under no constraints, this is the sort of growth rate you would expect for that particular fund that we were modelling. And you can see there are some which do continue to grow. There are some which collapse. The Guardian picked up on this and focused on the orange line, which is nobody works together and everyone completely ignores this as an issue, and pension funds are all wiped out within 35 years. So that's the thing they focused on and quoted. But it's about trying to understand where these systemic risks come in and how to then do something about it. This is another one, just how much it actually costs to pay into a defined benefit scheme. So there are lots of different ways you can start to build these sorts of models into investment returns, and then trying to understand the expectation around long-term return rates is quite important. So what we're trying to understand and what we're trying to model now is what sort of changes in circumstances. Are there some scenarios? Are there some particular things which create more volatility and step changes in financial returns and in investment asset valuations, which could then become correlated risk, which become political risk, which then could drive some other sorts of changes. So there's trying to bring this sort of systems view of the world together, look at the interdependencies of food, water and energy in particular, and then potentially metals if you're looking at things like going from fossil fuel energy into renewable energy, then there are some additional risks in there. But trying to put all those nested risks together so we don't all just say, well, the problem is water, so we just need to build lots more energy plants that can do desalination, because that will provide other problems. So can we get a bit of a smarter view on the risk over the short term, and our time horizons of 5 years for understanding these sorts of risks. And interesting, the question that came up earlier on is the investment standards and voluntary codes. So one of the big questions we've got is, do investment standards and voluntary codes and principles need to change and become more holistic or become more specific as well in light of some of the systemic risks that we're now starting to see coming up in the system? So I think I'll stop there.
Great. We have a few more minutes, so I'd like to first thank you, Dr. Jones, for this glimpse into what is clearly a very thorough and very innovative approach to capturing all these risks that are out there. The one I quite liked actually was one perhaps that in specific agricultural circles we're not talking about so much, was that fantastic globe where you showed the creditor versus debtor nations, and the big question I think for all of us, whatever industry we're in, and especially resource industries, how that's going to translate into who's going to have access to resources in the future. But I guess that's a whole other chapter. But what I'd like to do is maybe open up just to one or two quick questions, because then we really have to move on with our agenda. So please don't hesitate to ask a question to Dr. Jones. Yes, over here, this gentleman in the second row.
Perhaps I was just wondering, there was a lot of modeling, of course, being presented in a very good way. But let's say, if you're talking about the agricultural sector, did you also take into account, let's say, the availability of craftsmanship of farmers that, these people have to work the land. These are the success for the production, but has that taken into account in the modeling itself?
So, very interesting question. So within the model, what we are taking into account is the availability of working age adults. However, we're not taking into account the skills availability. So that will be a key thing to put into the model. So both the skills availability for solving a lot of the problems, there's not enough engineers in the world, but also there aren't enough agricultural experts in the world to be able to do this. So we're underlying some of these assumptions is if there are these risks, someone somewhere will make a sensible decision that we need more farmers, we need more engineers to be able to solve these problems. So what we're going to come up with is the best guess. Actually, you can solve these. This is how you can take forward a sensible investment decision, but it will completely rely on having the availability and the right sort of skill set, which we don't at the moment.